Good day. You are welcome to my channel. This is Kevin Davis Accounting. So previously we had looked at valuation of goodwill under partnerships, and then today I would like us to continue with our series about partnerships. Today I would like us to look at the admission of a new partner plus the revaluation of assets and liabilities. Now, when we are admitting a new partner to the partnership, one of the things that we are supposed to do, we are supposed to revalue our assets and our liabilities. Now, once we revalue our assets and we find that our assets have gone down, or we have made what they call a loss on revaluation, it means that the new partner coming in is not entitled to that loss. But if we find out that we have made a gain on revaluation, probably our figures have gone high for the assets. If we get a gain on revaluation, still we are supposed to share that gain amongst the old partners. The reason could be simple, that the new partner coming in was not there when these partners had to acquire those assets, or that new partner was not there when the partnership was having those liabilities. So we are supposed to revalue our assets and our liabilities. Now, as we are revaluing the assets and liabilities, we shall be required to draw up what they call a revaluation account. Now, the revaluation account has the same concept like the profit and loss account. So meaning that the debit side will be for expenses and the credit side will be for gains. So the revaluation account has the same concept like the profit and loss account. Now, how are we going to do this account? We assume that they're going to give you a balance sheet or the statement of financial position. Now, like I said, before the admission of a new partner, they have to draft a balance sheet as at that date before the admission of a new partner. Now, in that balance sheet, they can give you items like motor vehicle, and probably this motor vehicle could be 40,000. I'm just going to shortlist some items that could be given to you in the balance sheet. So they could have given you furniture of 20,000. Then they could have given you maybe inventory, and this inventory could be 10,000. And then probably we could have our payables here, and these payables, they could be around 12,000. So I assume this is part of the balance sheet that they have given us. I'm just picking out a few items. So they are going to give you a question. They're going to tell you that these assets and liabilities were revalued as follows. So they're going to say the following were revalued as follows. So they're going to tell us that motor vehicle was revalued to 55,000. Okay. Then our furniture was revalued to 15,000. Then probably we have inventory 8,000, and then payables 14,000. Now, if you look at this, the balance sheet gave us items, the assets. For example, a motor vehicle was 40,000. Now, this motor vehicle has been revalued upwards to 55,000. Now, the easiest way you can understand this, you're supposed to draw up an account, and you call it motor vehicle. Now, motor vehicle, it means now this balance here in the balance sheet, the amount in the balance sheet is going to be like our balance brought forward. So our balance brought forward is 40,000. Now, it means this was the value of the asset at that date. So automatically it makes it our opening balance. But then after this asset has been revalued, it means the closing balance is going to change from 40 to 55,000. So meaning you bring this on a liquid balance carried down of 55,000. See that? Then once you balance off this account, you realize that the credit side is heavier than the debit side. So you put 55,000 and then 55,000. Meaning that the increase of this asset account is 15,000. Because if it was 40,000 and it's now 55,000, it means there's an increase that is coming, which is 15,000. Now, this 15,000, I'm going to call it revaluation, because it has come as a result of revaluation. That our asset was 40,000. When you revalued it, it increased by 15. That's why its balance now, the balance carried down is 55. Now, once I do this and I've debited the motor vehicle account in the name of revaluation, every debit entry must have a corresponding credit entry. Meaning I'm supposed to perform double entry on this. Now, since I've debited motor vehicle in the name of revaluation, I'm going to come and credit revaluation account, and I say motor vehicle, and then I'm going to put 15,000 like that. So this is how we post to our revaluation account. Now our revaluation account is either we are going to put the increase or the decrease. So that's how we are going to treat for the motor vehicle. Then when you go to another account here, we have furniture. Now furniture is an asset, and all assets have a debit balance. So meaning my balance brought forward for furniture will be 20,000. Then automatically it means that this balance here for furniture, 15,000, becomes my balance carried down. So after revaluing it, we realize that our furniture is now what? 15,000. So if you look at this still, the debit side is outweighing the credit side, meaning there was a decrease in the asset value. So because of that, we have 20,000 here and 20,000 this side. So by how much did the asset reduce? It reduced by 5,000. And so you're going to call that difference revaluation. So what does revaluation mean? Revaluation means that what is that figure that is increasing the asset or decreasing the asset? Or what is that figure that is increasing the liability or decreasing the liability? Now, after putting the difference here, now I have credited the furniture account in the name of revaluation. So it means I'm going to complete my double entry by debiting revaluation in the name of furniture. So I'll put 5,000. Now, this is the quick one. Once you are doing a number on revaluation and you are requested to do something about revaluation, the revaluation account is only going to take the difference, either in the increase or in the decrease. For example, our motor vehicle was 40,000 and then it was revalued to 55,000, meaning there was an increase of 15,000. So the increase of 15,000 is this. So that increase is what we have credited on the credit side of the revaluation account. Like I said, that the credit side for gains, this is for expenses. So meaning that for furniture, rather, we had 20,000, and this 20,000, once it was revalued, it became 15. Meaning our furniture has lost value by 5,000. So that 5,000 have credited it, and I'm going to come and debit it. The simpler thing could be that once assets are increasing in value, you are going to credit the difference to the revaluation account, and then if assets are decreasing in value, you are going to debit the difference to the revaluation account. So that's how we do revaluation. And then if you look at inventory, our inventory we have an inventory account. So our balance brought forward for inventory is 10,000. But if you take the balance carried down for inventory, is actually 8,000. So it means that there is a loss in value of 2,000. So since there is a loss in value of 2,000, once you close off this account, you're going to have 10,000 here and 10,000. So meaning the loss in value will be 2,000. and this 2,000 you're going to call it revaluation. So after that, it means you're just going to come and debit it here in the name of inventory, and then you put 2,000. So that's how it is. Once an asset is decreasing in value, you're going to get that difference by which it is decreasing, debit it to valuation, and once an asset is increasing in value, get that difference by which it is increasing, credit it to the revaluation account. Then lastly, we have our payables. Now, our payables, they are liabilities. So unlike the assets, the payables, they have a credit balance. Now it means our payables, the balance brought forward for payables is 12,000. So I'm putting it on the credit side because payables are liabilities, and liabilities have a credit balance. Then my balance carried down is going to be 14,000. So I'm going to bring the 14,000 here. Okay, so it means that my payables increased in value by 2,000. So it means that once I balance this off, I'm going to put 14,000 here. So the increase is 2,000. Remember, as liabilities are increasing, we credit. So meaning I'm going to call this one revaluation, and then I'm going to come and debit revaluation account with payables, and then I'll put 2,000. So this is how we do our revaluation. So it's all about to know which side is, are we increasing the asset or decreasing the asset? Are we increasing the liability or decreasing the liability? So there's a simple rule that we can use to help us out. And the simple rule says that once assets are increasing, that's a simple rule, and also liabilities are decreasing, okay, you are going to get the difference. You debit, once an asset is increasing and liability is decreasing, you're going to credit the difference to the revaluation account. So once an asset is increasing or a liability is decreasing, you're going to get that difference by which the asset is increasing or by which the liability is decreasing, and then you're going to credit it to the revaluation account. So meaning, for example, here our asset was increasing by 15,000. So that means that's why we credited 15,000 to the revaluation account. Still, when an asset is decreasing and the liability or liabilities increasing, you're going to get that difference and then debit the difference to the revaluation account. Please mark, I am talking about that difference. We are supposed to credit the difference that is causing it to either increase or decrease. We are taking that difference to the revaluation account. So that is how we do our revaluation. So we are going to do a number about revaluation, and I guess after doing the number, your understanding will be enhanced.